No one could have predicted the new world of work and the uncertainty caused by the global pandemic. One way or the other, we were affected by loss, from personal or professional perspective, to our sense of safety, social connections, and financial security. Nonetheless, individually and collectively, we have navigated through these uncertain times. We have learned to adjust to a new normal as a society and a profession to look to the future as we continue to develop, influence, and lead. Our member value proposition gives members and associates a high-level understanding of the benefits and providing a detailed outline of the initiatives available to members and associates. To all our difference makers, our valuable members, we thank you for making a positive and quantifiable contribution to the economy. Over the past year, SAICA delivered the following thought leadership offerings to its members: Business Emergency Rescue, CEO Roadshow, Courageous Conversation Series, Finance Leaders Series, Friday Knowledge Cafes, Leadership Evolution Masterclass Series, October Ethics Month Series, TaxCon 2021 Harnessing Change, Tech Talks, Virtual Career Network, Wellness Sessions, Women in Leadership Conference, and so much more. As we wrap up 2021, look out for more offerings by visiting the SAICA website at saica.org.za or read the monthly calendar of events newsletter. The CPD declaration submissions are opening soon. In line with the new policy, all members and associates are required to submit an annual CPD compliance declaration by 31 January 2022, detail their professional circumstances on the annual declaration, whether they are professionally active or not. Follow an output-based measurement approach by demonstrating the maintenance and development of relevant learning on a CPD reflective plan. Undertake relevant CPD. Remember that all CPD declarations will need to be done via the SAICA member portal. Have you used the member portal? You can log and track queries with SAICA on the member portal. This eliminates the need to call the contact center or send an email. It's quick and easy to use. Visit the SAICA website, www.saica.org.za, and click on the Member Portal tab to sign up. Connect with the regional executives. Our regional executives are here to help you with any queries you may have. They aim to make your engagement with SAICA exceptional and memorable. Connect with them. Recap: SAICA member value proposition, SAICA offerings, recordings available for catch-up. CPD declarations are opening soon. All CPD declarations will need to be done via the SAICA member portal. And most importantly, stay connected.
Good morning, ladies and gentlemen. A very warm welcome to you on this slightly overcast, slightly cool morning in Pretoria. But we're very grateful for the rain that we've been having over the last day or two. Thank you again for joining us. This promises to be a very exciting, very informative session this morning. The topic of audit reform, and in this particular session, a focus on fraud. It gives me a great pleasure to introduce my colleague sitting to my left, to your right, Ntsoane, Project Director at SAICA. Good morning, welcome. Please take our members through what they can expect this morning.
Morning. Thank you, Milton. Good morning to all our members and to all our non-members who've also joined. So as Milton said, my name is Ntsoane, Project Director within the Audit and Assurance Division here at SAICA. And really today our discussion is around the topic of audit reform. Well, I say audit reform, but I think myself and Milton know by now that the ecosystem is a bit wider, so the focus is wider than just the auditors, and we're looking at the corporate reporting and audit reform. I think that's probably the more appropriate term, Milton.
The financial reporting ecosystem.
Perfect, correct. And that's what we're talking about today. The focus is on fraud, what the role of the various role players is when it comes to fraud detection and fraud prevention. So we've got quite a high-powered panel lined up for you today. We've got, I'll let Khaya introduce all of the speakers just now, but perhaps just to introduce our facilitator, Khaya Sithole, a graduate of KZN and Oxford University, hosts a very well-known business show on Power FM. So Khaya also serves on a number of boards of the JSE-listed Stadio Holdings, where he is chaired the audit committee on that front as well, and Chikulu Social Investments Audit Committee as well. So he currently also serves on the boards of Lefika Lapodiso, which is the Art Therapy Institute, where he serves as the board chairperson. Khaya, let me hand over to you. We're really looking forward to a very robust discussion on fraud this morning.
Khaya, good morning. Can you hear us?
Yes, I can. Yes, I can hear you. My sound disappeared there for a moment.
Right.
Thank you very much for the introduction, and good morning to everyone. And I think the importance of today's conversation cannot be overestimated. We know very well that for a very long time, South African financial reporting ecosystem was indeed lauded as one of the best in the world. But since then, there have been developments that have then called into question perhaps the way in which things are done, and more importantly, the way we react into when things do go wrong. In relation to that, what we have seen is that there's been this growing disconnect between what society thinks the financial reporting ecosystem is about and the reality of what happens there. So in conversations of this nature, what we're really trying to do is to really try and figure out how to get a more cohesive understanding across society at large of what really happens and how we need to deal with the type of issues that we see emerging from time to time. I'm privileged to be joined by a very esteemed panel of guests and experts who've done some work within the financial reporting ecosystem for many years and understand what the entire value chain looks like. The first panelist I'd like to introduce is Tanya Wimberlin. She is the head of the Financial Reporting Division in the Issue Regulation Division of the Johannesburg Stock Exchange. Very, very well experienced in matters of regulation and, of course, understanding how the interaction between the capital markets and the rest of society ought to work and what the key issues are. Good morning to you, Tanya.
Good morning, everyone. Thank you very much, Khaya.
Our second panelist is Ntsoane, who in these days serves as the EY Africa Assurance Leader. He also, in his spare time, if he finds it, chairs the SAICA Assurance Leaders Forum, clearly a very long-term member of IRBA and a very, very, very keen auditor, and I think he wears auditing in his sleeve. Good morning to you, Stephen.
Morning, Khaya. Thank you, and happy to be here this morning.
Usually I run a radio show in the evening, so I have this habit of saying good evening to everyone that I greet. So it's supposed to be good morning right now. We also have joining us for this morning's panel, Marco Adaggi, who currently serves as the Managing Director in the Sales and Marketing for the VW Financial Services. Also quite an esteemed track record in financial statements preparation, particularly in the many years that he spent at WesBank amongst other organizations. Good evening to you, Marco. Marco, you are muted.
Good morning, and thanks for having me here today. Looking forward to it.
Thank you very much. Thank you very much. Our fourth panelist for this morning is the person with the greatest sense of skepticism on this panel, and that is Mario Fazekas, who is in the forensics department at SNG Grant Thornton and also a certified fraud examiner, someone who spent many years trying to unpack and unravel what the type of things that have gone wrong in different organizations and different ecosystems are. Good morning to you, Mario.
Good morning, Khaya, and everybody else. Good to be here. Thank you.
Our last panelist for this morning is, of course, the chair of ENS himself, Professor Michael Katz, a very distinguished doctor in law and a man who served on many governance structures and probably has the greatest level of institutional wisdom about the development of the corporate landscape in South Africa over the past 30 to 40 years. Good morning to you, Michael. Michael, you're on mute.
Morning. Thanks for inviting me. Thanks for your kind words.
Thank you very much. Tanya, I'd like to start with you. Obviously, the JSE being the main market in the country does become the primary prism from which a lot of people assess the integrity of the country's capital markets, for example. And of course, that simply means that whatever happens within the corporate landscape, people are likely to come to the regulator and say, wait, tell us about the status of the financial reporting ecosystem in the country. And of course, you as the regulators are continuously learning and continuously trying to understand what it is that needs to be communicated and how well it is being communicated or not being communicated. In recent times, we've also seen some of the issues that have emerged in Tongaat, for example, and in Steinhoff that has seriously dented the credibility and the standing of South Africa's capital markets. As a regulator, what has been your view about what has really become some of these big talking points and this expectation gap that you're referring to?
Khaya, thank you very much. I liked your term prism. You're quite right that the JSE does become the focal point and the main and the first source where people refer to when there is a problem, and particularly in the context of today's discussion, that there is a fraud within a listed company. And it was exactly for this reason that earlier this year, we issued a document called the Issuer Regulation Guide, and it sets out the JSE regulatory landscape, really reminding investors and the public as to the ecosystem that exists, that at the heart of everything is actually the company. The various regulation that the company is then subject to, the directors, their fiduciary responsibilities, King, which talks a lot and governs around how directors should take their responsibility from a fraud perspective, shareholders' responsibilities to make sure that they have an eye on the company, that they are questioning the directors, that they make sure that they think about their appointment of the directors. Within that, the JSE plays a part in terms of regulating its own requirements, but the JSE is not responsible from a fraud perspective. We don't have the jurisdiction to prosecute people from a fraud side of things. Yes, we try to enable and to facilitate and create an environment where various role players come, so the directors, management take responsibility for the financial statements. Yes, the auditors are there to play an important watchdog, but everyone needs to play their particular part. And the reason we issued this particular landscape document is to remind everyone that, unfortunately, the JSE cannot solve and actually even prosecute for fraud or the likes. We can try and move the pieces around to try and prevent these sorts of things or to make it difficult as much as possible. But ultimately, we're not the only players. And you'll see in this landscape document, we refer to other important players as well, in addition to those with those heavy, hard-hitting, like the police, the MPNA, the likes of those parties that you'd expect to take action. You'll see we also refer to the likes of SAICA. And I think that SAICA has been playing a very positive and proactive role over the course of this year with their huge focus on ethics and culture. Because ultimately, you know, we can have as many rules as we want, but if we don't have an ethical culture, you know, I don't think we're going to be moving in the right direction.
Stephen, I'd like to bring into the conversation now in that when we do actually tend to look at financial reports that are published through the JSE in particular, whilst there may be many people involved in that ecosystem, there's always that one signature in particular that we all look for, and that is the signature of the external auditor. So for a lot of people, that becomes the person that says, well, if I'm willing to put my name onto this particular document, it clearly means that I inherit all the associated expectations. So of course, when something goes wrong, one of the first things that people do is to look for who the auditor was. And perhaps that's a creature of the audit signature being the one name that you see prominently there, and maybe not many people then know who else makes up that entire ecosystem. Does the burden, the liability burden, essentially lie heavily on the shoulders of external auditors?
Yeah, Khaya. So firstly, thanks for introducing this topic around the financial reporting ecosystem. I think that in itself just tells you that in dealing with the issue of fraud, this is a matter to be addressed by the entire financial reporting ecosystem. So I'll touch on the auditors in a moment, but I think I want to just expand on what Tanya referred to earlier on around the responsibilities of directors those charged with governance and management. I think that's where it really starts. I think the first way to deal with fraud is to prevent it. And this requires those charged with governance and management to design and implement internal controls to make sure that they can prevent and detect fraud. And then over and above that, you need strong corporate governance to make sure that there's an effective monitoring process around the effectiveness of all of the measures that have been put in place to deal with fraud. I think that's the first thing. And I think this deals with the concept of multiple lines of defense. The auditors are not the first line of defense, and therefore you would require those lines of defense that come before the auditor to actually be effective. But let's move to the auditor and the responsibilities of the auditor. I think these are outlined by ISA 240, which is the fraud standard. But before you could even go into the accounting standard, I think there are certain hygiene factors that one requires an auditor to have before they could even start an audit. And that's about integrity, this is about ethics, this is about independence. And this is important because I think it lays the foundation, it's the starting point. And firm management or management of audit firms have got to make sure that they operate quality management controls that ensure that these hygiene factors are indeed embedded. Now, moving into the responsibilities of the auditors per the standard, are required to identify and assess risks that are fraud risks. And they have to design procedures to respond to those fraud risks. Now, if you just follow that analogy, you'll also realize that in order for you to come to a conclusion around fraud, you have to have done sufficient work around the risks that you've identified to be able to express that reasonable assurance that financial statements are free from a statement related to fraud or error. I think there's a basis for the questioning mindset from the public out there to say that when corporate failures happen, where were the auditors? I think that question is appropriate. But I think I want to emphasize this point that says that the level of assurance that is provided by auditors is that of reasonable assurance and not absolute assurance. And I think that's where the expectation gap has been predominantly lying, that issue of the extent or the level of the assurance that is being provided by the auditor. But with that said, Khaya, I want to say that it is incumbent on the auditor to ensure that they properly assess all the risks that are related to fraud and design the appropriate procedures in order to respond to that. And when they conclude, when the auditor signs off that audit report, they ought to have ensured that they've assessed all of those risks and they've got sufficient evidence to mitigate whatever risks that have been identified related to fraud.
Thanks for that, Stephen. Marco, Stephen raises a rather crucial point, and this is the idea of reasonable rather than absolute assurance. And of course, it's within that tension point where you then have to say, oh, by the way, all with what was reasonable and not absolute assurance. At a point in time when people are saying that something has gone wrong, they are probably not going to be satisfied with this answer that says, but we were not doing an absolute test. Historically, perhaps there were a lot of merits onto why it had to be sample-based, for example, on why you could only have a limited prism as an auditor. Over time, evolutions in technology and the way we do work, is this still something that we have to stick by to say that it's never going to be an absolute science, it's never going to be an exact science? Or should we then explore the question of, well, if society thinks that perhaps absolute is what we're closely looking for rather than reasonable, which seems to be swinging in the pendulum somewhere and not necessarily very clear about what it means, should we then consider trying to move closer to the question of absolute, however one defines an absolute assurance?
Khaya, thanks a lot. Look, I think we need to start off with a couple of ground rules in my mind. I think, one needs to start off with culture to make sure that people understand that fraud has a zero tolerance within the business. I think there needs to therefore be structures also in place so that one can report and deal with the fraud. I think the challenge with fraud is that there's a level of misrepresentation that happens, and whether one can get to a point where it's absolute and the chances of it happening is zero is probably not very realistic. But I do think each stakeholder in an organization needs to play its part. And I think through the various structures and through the various parties, your first, your second, and your third line of defense, you should get to a point where, you know, the entire ambit is covered. And that may give you or get you close to that absolute, you know, utopia that everyone, you know, should strive to get to.
I think it's the pursuit of that utopia that is going to be the continuously elusive goal of all auditors and everybody within this ecosystem. Mario, you obviously always come in with the more heightened level of skepticism, if I may call it that. As a forensic auditor, you tend to wear the set of eyes that says that I'm going to work from the basis that something has probably gone wrong, rather than me saying that it looks like everything has been working well. That sense of skepticism that forensic auditors tend to wear in particular, is this a type of thing that perhaps should be more embedded into the entire financial reporting ecosystem, so that everybody who engages with the numbers, everyone who engages with management, sort of starts from a prism of saying, actually, let me comb through this with the fine comb, rather than me simply ratifying and simply, you know, gleaning over what has been provided to me. Do we see enough levels of skepticism within the ecosystem?
Thanks for that, Khaya. I don't think so. I wrote 2 articles for Accountancy SA over the last 2 or 3 years, and that was a request from SAICA, because I think it's been picked up that some auditors are not professionally skeptical. I would consider myself cynical as opposed to professionally skeptical. There's a difference between the two. And if you look at auditors, the minimum should be professional skepticism, which means if you look at the continuum, you've got trust on the left-hand side and mistrust on the right-hand side. So in the middle is neutrality. As auditors, we should be neutral. Then you've got presumptive doubt and then complete doubt. As a forensic auditor, I sit in presumptive doubt. And I found too many auditors have got a relationship with the client, and that tends to cloud their judgment. You know, we're human beings, we are biased. And that's why if you have a look at that, what we call the skepticism continuum, which actually comes from a very nice little booklet which can be downloaded from the internet called Enhancing Auditor Professional Skepticism, you'll notice that these 4 areas overlap. We should start with neutrality, but it does overlap with complete trust. And that's where I think a lot of auditors go wrong. They're not getting the evidence. When we're doing investigations and we say, how did you come to this conclusion? Oh, well, I asked the CFO. That's not audit evidence. So there's a reluctance to go and get the evidence because the CFO might say, don't you trust me? You know, I told you, I gave you the answer.
Thanks for that, Mario. And I suppose when we do look at the way in which auditors and management interact in particular, it is undeniable that all of this, a lot of it is actually based on pre-established human relationships and interactions where perhaps that sense of trust gets built up over time. And if an auditor comes back 5 or 6 years down the line and starts suddenly asking the type of questions that look like, you know, it's from someone who's never engaged, it may create those tensions which then say, wait, hold on, why are you asking the things that you haven't been asking for all these years? How do auditors then essentially navigate that, in that they need to remain eternally vigilant, but also understand that as relationships grow, that sense of trust does indeed become more entrenched over time, Mario?
Khaya, very good point. You know, we auditors now that haven't been professionally skeptical, all of a sudden are going to have a different attitude when they come back to the business. I was doing some training on the IAT program, Internal Auditor Technician, which is the IA. And one of the auditing firms did in-house training. And I said to them, you need to ask certain questions when doing your audit, not accusatory, just general questions. So, for example, my job as an auditor is to deter fraud. So I just need to ask you some fraud-related questions. Is that okay? Most people will say, yes, no problem. And then we ask, do you think this organization has any problems with fraud? Why or why not? Has anyone ever asked you to do anything illegal or unethical? If they did ask you, what would you do? 3 simple questions. And the attendees, all of them said to me, we could never ask those type of questions. I said, why not? And they said, well, the partner at our induction training said we should not ask questions that make our clients uncomfortable.
That's a very, very scary statement to hear, unfortunately. Professor Katz, when we were deliberating earlier on, Stephen and Marco sort of referred to this triple line of defense that we usually talk about, in that first and foremost, you're hoping that the management that has been appointed are themselves people who are of sound mind and ethical enough to run the business properly. But of course, beyond that, then there's also these internal checks, whether it's the internal auditors, before we get to the regulators and we get to the external auditors, for example. So it seems that within the design of the system, we have considered some of the key variables that need to be explored in order to ensure that we do not see a lot of these fraudulent activities essentially emanating or emerging from these organizations. That being said, we still see far too many instances of things going wrong. Is the governance system fit for purpose in relation to what we now know about how big and how pervasive fraud can be in some rather very well-established organizations, for example?
Okay, if I may, Khaya, just following on from what's been discussed up to now, I just want to draw attention to two passages from the Bryden report. I'm not answering your question yet, but I thought it would be interesting to do so. He says, I disagree with the conclusion laid out above. It is instructive to consider what happens when a deep suspicion of fraud emerges. Generally, forensic accountants are brought in to examine in much greater depth the area concerned. Auditors, however, start with a neutral mindset, assuming neither honesty nor dishonesty with respect to the preparation of the information provided, and seek confirmation of its appropriateness. This aspect of seeking confirmation will be referred to in the next session regarding the fit of the auditor. If there is to be a reconciliation between this reality and the widespread expectations about what is sought from the auditor, auditors need to learn to be able to apply the same mindset as do forensic accountants in relevant circumstances. I have commented earlier on the need for an auditing profession in developing the syllabus of the auditors, leading to a qualification to practice. And then he says, I recommend that training in both forensic accounting and fraud awareness be parts of the formal qualification and continuous learning process to practice as a financial statements auditor. In developing qualifications for auditors of other areas of activity, parallel training should be established. So this neutral mindset of auditors is something that's problematical. And I think Bryden sets it out very well. The other thing, just listening to previous speakers, that comes from the Bryden report, what the duty of auditors should be. And I think that he puts it very well when he says what the purpose of an audit is. No longer true and correct or true and fair. In England, up to 1947, it used to be true and correct. Now it's true and fair. But he said that should be replaced with the following. The purpose of an audit is to establish and maintain deserved confidence in a company, in its directors, and in the information for which they have responsibility to report, including the financial statements. So I think that the purpose of an audit has to, the whole model of an audit has to fundamentally change. So just by way of background to, in a modern board functions in law, by and large, is to determine strategy, to make key appointments, to determine their key performance requirements, and to monitor it. And I'll do it later in this, to establish proper systems and controls. But I think the starting point of a board today is to ensure the selection of top management and to monitor their performance. And in monitoring their performance, the case law in America is changing. It's not only financial performance. It's behavior. It's more than simply financial. But we can come on to that a little later.
Yeah, thanks, Professor. And I suppose the takeaway from the Bryden report, Tanya, this idea that perhaps we need to relook at the purpose is something that requires a lot of deliberation. And my suspicion is that if one even went back to many years ago and when the origins of the auditing profession being so embedded in the corporate reporting ecosystem, there would have naturally been resistance. And the very first basis for resistance is simply the question of who should bear the burden of doing this. Every single company that you engage to will start from the prism of saying, we've appointed the right people, so therefore we do not believe that the risk exists. Does this then mean that if we are going to explore the ideas in the Bryden report, for example, that says relook at the purpose, we naturally expect that there's going to be pushback that says, no, we are good, we don't need this, go and find the people that are essentially the fraud risks, as it were, Tanya?
So I think it's important to recognize that the work that the IASB, so the Auditing Standards Board, is doing in this. So they've put out a discussion paper really exploring this topic of how does the auditor deal with fraud. They also raise questions about going concern. But all of this is in light of various jurisdictions' corporate scandals. And just listening to and picking up on some of the commentators who've been making these various comments before. I mean, Stephen's talking about the fact that the audit is following the standards. So if one wants to change a mindset, to Mario's point, where on that spectrum do they come in? You would have to then change the auditing standards. So this particular discussion paper specifically asks, would requiring a suspicious mindset, so no longer professional skepticism, but would requiring a suspicious mindset contribute to enhancing fraud detection? So I think there is a recognition and there is a response to these questions that have been raised. Is the audit going far enough? This defense always that it's the expectation gap, it's not our fault as the auditors, you shouldn't be asking this of us because we can't do it. The challenge is to then change the auditing standards to align what the auditor does with what the actual expectation is in the public, as opposed to historically the trend being to continue to expand the narrative of the audit report, which is to remind people we're not doing what you hoped we would do.
Yeah, and I think obviously that constant reminder that, by the way, we don't do the things that people expect us to do, Stephen, is probably the one thing that doesn't help in lending credibility to the profession itself, because I imagine a lot of people that hear that answer tend to emerge from that conversation disappointed rather than, feeling enlightened or energized by the conversation itself. What could be the possible permutations of reforming the auditing profession itself and the auditing practices, so that even if the answer remains that wasn't actually what we're employed to do, but it is something that within our practices we get much closer to detecting and dealing with? Is there a possibility of us relooking at how auditing practices are?
Yeah, certainly, Khaya. I believe that there's lots for improvement, including the work that Tanya referred to now, that is being done by the IASB around possible improvements or changes to the fraud standards as they said today. There's certainly more that can be done, and auditors should do more when it comes to the issue of fraud. So, interesting debate about this topic of professional skepticism versus suspicion. I think many different inputs around that, where you've got advocates for auditors moving from a mindset of professional skepticism, but much closer to that of suspicion. Now, both of them have got their own, call it consequences, if you like. So there's a view that says that professional skepticism is insufficient to allow the auditor to have the right mindset around fraud, and therefore the mindset has got to shift much closer to that of suspicion. Now, if you go to suspicion, that also means that even the work that you do as an auditor moves much, much closer to the work of forensics, or infusing quite a lot of forensics type procedures into the audit. Now, I think the answer lies in the middle somewhere, Khaya. I think that professional skepticism has got to be the starting point. for performing an audit. However, where an auditor has identified risk factors that warrant suspicion, the auditor must act with suspicion when it comes to those specific circumstances. And when you get to that space, that then speaks to what type of specialists do you now need to involve in the audit? Do you need to involve the forensic specialist to come and help you with that assessment? And I think that ultimately, at the end of the day, we have to make sure we find the right balance, because there's also a view that says if the audit moves towards becoming some kind of a forensic investigation, that will make it very difficult for the audit to actually be effective, because that will inform and change the posture of management and those that are subject to the audit, which may just defeat the whole purpose of actually performing an audit and make it extremely difficult to do so. However, I think that there is certainly a lot more that we ought to be doing to make sure that when we have those instances of high fraud risk factors, and by the way, the assessment of the fraud risk factors has got to be very robust. And I think that's where we need to improve, where we need to be much more robust, use both internally obtained information, external information that is not provided by management, in order for us to identify fraud risk factors, including the use of forensic specialists to help the audit teams in identifying fraud risk factors. I think what Bryden refers to around the training is also very relevant, because the reality is your auditor today is not somebody who's trained to detect fraud per se, is not trained as a forensic specialist. But we need to start building that into the curriculum, because what that will do is to further inculcate the thinking and the mentality that says there is a real risk of fraud in conducting the audit, and therefore you have to have a mindset that seeks to mitigate those risks with the procedures that you are performing as an auditor.
Stephen, I mean, in current practices, you don't go and audit a bank without the services of an actuary, for example. You don't go and audit an insurance company without the service of those specialists who, even though they're not trained as traditional auditors, their value in the audit is well understood. And if we've been able to sort of move in that direction and say, let us have these multidisciplinary skills within a particular audit, it seems to me that perhaps the absence of forensic auditors is something that is easily overcome. And yet for some odd reason, the profession hasn't moved in that direction. What's the reason for that?
Yeah, and Khaya, I think that if you look at what is happening currently in the profession, you will see a lot more use of forensic specialists as normal parts or members of the audit team. And I think that's part of the direction that we need to take, where forensic specialists become embedded in the audit team, particularly to assist audit teams with the identification of fraud risk and designing the most appropriate responses to those fraud risks. I will say that this is something that has not been, call it the norm, but has rather been the exception, the involvement of forensic specialists. But we need to move to a world where forensic specialists, cyber specialists become a normal part of an audit team. And I think that's the direction that we should take.
Yeah, Tanya, back to you. I mean, when we do talk about these additional skills that you'd like to have on audit teams, for example, one tension point that seems to exist is that there seems to be a very strong and a very clear regulatory regime in relation to the person within the audit team that says, I'm a registered auditor. There doesn't seem to be very clear accountability lines or accountability frameworks for all the other skills, should it turn out that the reason we weren't able to value the impairment loans of the loans of a bank properly was because the actuary guy on our team let us down. Are we seeing that regulatory gap in relation to the people that are indeed taking part in audit now, and yet if something goes wrong, the answer naturally gravitates towards the auditor, because not only is that the person whose signature is there, but let's face it, it's probably the only person that we know how to hold accountable in relation to the rules as they sit today?
So I guess, Khaya, that the first point is you talk about that we hold the auditor accountable. I think within a South African context, I think many would challenge you on that comment and would raise a question of, have we actually? So you're making the point about who we go after. Once, someone has been gone after, as it were, and are held accountable, are we satisfied that they were held at a high enough level? So these cases of massive fraud can be enormously crippling from an economic perspective. And whether it be the auditor, the directors, the management, so not just within the audit, but across the whole ecosystem, I think that you would be hard pressed to argue that the various regulators, the various individuals or organizations that have the power to enforce requirements have done sufficient to hold these individuals accountable. If we can get that aspect right, if we can hold individuals accountable, the auditor, management, directors, etc., then perhaps we will start to get this reference to a credible deterrent. If there's no credible deterrent for a misdoing, then people will chance their arm. So I think the comments about holding people accountable goes across the whole ecosystem. And I think that more needs to be done. And you asked your question in the context of the auditor. I think more needs to be done by the audit regulator. We're aware that they've had recent changes that have come through to their act, and that will then give them more ammunition. And I guess we need to then see how that plays out. So now that they have this bigger gun, will they actually use that gun? Within the actual process that they follow, ultimately, if it's with regards to an audit report, the auditor does take responsibility if they're relying on another party. So they need to be making sure that they've done their sufficient checks and balances to hold those individuals accountable. In terms of the various individuals that they might use within the audit process, absolutely, that then is then different jurisdiction or regulators that potentially come into account. And as I say, that then is a problem that extends not just to the actuarial or whoever the other individuals that are involved, but it goes to all individuals that have been involved in committing the fraud. I mean, we keep focusing on the auditor. It's not that the auditor typically has committed the fraud. The question is, why did they not uncover the fraud? And I say typically, I mean, obviously there are some cases where we're aware that they have collaborated with and have facilitated the fraud, but there are obviously different extremes.
Thank you. Marco, as a financial statements preparer, I imagine the honest truth is that in auditing is still the grudge exercise, the thing that regulators have imposed upon us in order to keep the system of capitalism honest and in check. If we are now talking about some of the Brighton recommendations, for example, to relook at the purpose of an audit, I imagine that it may be a resource issue for financial statement preparers. It may even be a time issue. How would we then get the right balance in saying auditors need to do a bit more? They need to look into a bit more and also not cripple businesses so that they don't essentially migrate from one audit to the next and forget to actually run the businesses that the stakeholders are paying them to run. You're muted, Marco.
Khaya, thanks. I think just listening to some of the comments is, I mean, firstly, I understand the commercial relationship between the auditors and the business, but I do think there needs to be a level of honesty and engagement. I think there's nothing wrong with challenging management, provided that you have the sufficient evidence on hand or you have a degree of concern to raise it directly with management. I think that's the starting point of it, is that there has to be a level of transparency in engagement. I think everyone needs to understand that they do play a role, and to have that transparent and potentially uncomfortable discussion is part of the engagement. I think, the audits and depending on the size of the entity and the complexity that generally comes with it, I think, at the end of the day, the audit focuses on a multitude of aspects and has to get through a number of various aspects of the audit. I mean, fraud is only one component. And again, I suppose it's the engagement not only with the financial community within the organizations where they need to engage and get an understanding of what's happening in the business. So I do think, while the strain during audit time does sit with a particular portfolio, the reality is there is a need, I think, to expand on one's understanding of the organization as a whole, and that doesn't necessarily come with a cost to the organization or the financial community who sits there and prepares it. So I do think that, when one takes a look there is a need, and especially given some of the current failures that have presented themselves, there is a need to make sure that people's trust in the auditors, in management, is re-established. And if for a period of time this requires a little bit more pain up front by both the company and the auditors, I think it is important that becomes a focus.
Yeah, Marco, recently the JSE itself has actually introduced a new paragraph in its listing requirements, and this requires a sign-off by the CEO and the CFO on a prescribed statement talking about the effectiveness of internal controls. Now, my primary concern is that I do not imagine that there's ever going to be a CFO or a CEO that signs a statement that says that our internal controls were defective, because I imagine what that will do is that will trigger so many processes. You may never see it in the public arena because the auditors will say, well, you literally are confessing that they're red flags, so therefore we're definitely going to look at things in a different way. Are we not running the risk of every single CFO and every single CEO simply saying yes? Because, well, as far as I'm concerned, if nothing is going on in the business, therefore that is proof that the internal controls are working, rather than them effectively interrogating them or proactively interrogating them and then coming up with that statement. Is it simply just a tick box exercise?
Khaya, I'd like to believe that it's not, because I think if one takes a look at all of this, eventually everything comes through the wash. And I think it's far more embarrassing for the company, for the auditors, to deal with it when it becomes, let's call it the front of the newspaper, or it becomes some sort of media hype. I think, companies go through various cycles in their lives, and sometimes they're expanding in aspects like that, where their financial controls may not necessarily be as strong or as prudent as they normally are. And I think that would strengthen the transparency to admit that in certain areas, the controls are not where they should be. And that may become a focus from the auditors, which will then give management, again, reassurance that either they've got a rather large gap or they don't. So again, I do think that some of these things can actually be to management's benefit, when someone independent looks at it and kind of identify some of the blind spots, but also is prepared to say, okay, it's not as bad, or listen, you've got an issue here, and if it's not dealt with, and that's the thing, management must also take responsibility for it and deal with the gaps, so that at the end of the day, as one progresses, you get to a point where all your gaps are closed off, and that you are able to place really true reliance on your internal controls, and then with confidence, the CFO and the CEO can sign that off and know that it's not just a tick box exercise.
We hope so. Mario, one of the points that Marco just mentioned now is this idea of blind spots. And I imagine that in the world of automated business processes, the risk profile or the IT security risk profile of any business has enormously escalated. And of course, in our conceptualization of fraud, we do also consider fraud that is perpetrated by third parties as the fraud dimension that needs to be explored here. Now, in light of the fact that every single business is now essentially working in this cybersecurity environment where the risk factors are that much higher, doesn't that on its own become the basis for every business saying it's in our collective best interest as a business to actually have this forensics mindset? Because we may not be the ones perpetrating the fraud, but if somebody external is able to crack our systems and be able to take resources, and either it's the information that we have in relation to clients, that is something that we unfortunately are accountable for. So no one ever says that it was the hackers that were responsible for it. The question is, why were you as a business not ready for a thing that is now known to be a real risk of how a business operates these days?
Thanks, Khaya. Yes, and that's where awareness training comes into it. Training people on the red flags. And again, we can't make every auditor a forensic expert, but we can at least train the auditors in red flags and train the rest of the staff in the red flags and how to recognize them. You take phishing and ransomware attacks. People are clicking on links that they shouldn't be clicking on. These criminals are doing their homework, so they're finding out who likes golf. So they will send an email with a free golf magazine subscription, knowing that there's a good chance that person's going to click on it. So everybody in the organization needs to have this skeptical mindset to say, why would somebody send me a free golfing magazine? let me analyze the link. Does it look legitimate? If I put my cursor on the link, the little box pops up showing where I'm actually going. Am I actually going to Golf Weekly or Golf World or whatever the magazine is called? And then to combine awareness training with accountability, because you're going to get employees that just don't care. They'll sleep through the training and so on. So what organizations are doing, they're taking memory sticks, distributing them and seeing who's going to pick up the memory stick and actually plug it in. In the training, it tells you do not plug in memory sticks that you pick up lying around, hand them into IT. And that's where the accountability element hangs over somebody's head to say, I better do what I'm supposed to, otherwise I'm going to be on the end of the stick.
Professor Katz, one of the points that has been mentioned in conversations of this nature is whether we should indeed impose this burden upon the boards of directors to proactively tell us on an ongoing basis what exactly it is that they did to sort of assess the fraud risk profile of the entity and how they then address this. So, of course, that would mean that they have to do a bit more. They need to do the type of interrogations that we now acknowledge probably aren't happening as robustly as they need to have. And I imagine perhaps it's a conversation that's easier for a board of directors that have employed me as an executive manager for them to ask me the questions if it turns out that the auditors are still hesitant to ask those questions because it creates new tensions there. Is this something that we should be exploring, the question of whether boards of directors should indeed be telling us more about what they individually and collectively did to do this assessment rather than simply relying on managers saying that everything works well?
If I may, Khaya, just one very quick thing again, just to say something about the auditor's duty. And there was a very famous case, Pacific Acceptance Corporation Limited versus Foresight. And the judge there said the auditor's duty is not only to look at everything, ultimately to comment on the financial statements. If during the course of the year, the auditors, an audit clerk comes across a fraud, auditors mustn't believe that their duty is simply to report to shareholders. Their duty is also to report to management, to the board. So if during the course of a year, a fraud is discovered, the auditors don't wait for the end of the year and qualify the accounts. They must immediately engage with management to follow that up. And I think that's something that the emphasis on the preparation of the financial statements is a little overplaced. It's an obligation that endures throughout the year with duties throughout the year, and that was held in the Pacific Acceptance case. On the duties of boards, Khaya, the board's duty is to ensure that they have adequate controls before reporting to the outside world what their duty is. Their ongoing duty is to ensure that there are adequate systems and controls. And this was held in a famous, the Kingston case. And what was said there is, fourthly, an objective standard of care is not inconsistent with extensive delegation, nor, however, does it permit the directors to escape from the second requirement of always being in a position to guide and monitor the management. These two things are to be reconciled by the directors ensuring that there are in place adequate internal control systems which will throw up problems in the delegated areas, whilst there is still time to do something about them. As it has been put, the freedom to delegate does not absolve a director from the duty to supervise the discharge of the delegated functions. So before we talk about the board's duty to report on what they're doing to prevent fraud, you've got to ask what their substantive duties are. And that is to have adequate systems and controls that will throw up fraud, the prevention. Okay, that's the starting point. Now let's talk about their reporting duties. Those reporting duties are contained in section 29 of the Companies Act, read with section 30. And if we just look at section 29, I'll start rather with 30.3. So in 30.3, the annual financial statements of a company must, A, include an auditor's report if the statements are audited, include a report by the directors with respect to the state of affairs, the business and profit or loss of the company, of the group of companies, if the company is part of a group, any matter material for the shareholders to appreciate the company's state of affairs, and any prescribed information, and then be approved by the board and signed by an authorized director. So included in the director's report or in the financial statements must be the auditor's report. And in current times, my experience is that one of the important things in an auditor's report are to identify the material risks of the company and to comment on whether the mitigations exist. So yes, the totality of the director's auditing requirements, I think, would include the steps they take to mitigate control risks. But their most important duty is to approve the financial statements. And if we have time, I'll tell you, there's now been a leading case in Australia where the Australian Securities and Investment Commission, ASIC, sued the directors of a company, the executive directors, the non-executive directors, and the prescribed officers for approving financial statements that didn't give a correct view of the company's affairs. And in that judgment, if we have time, I'll read some critical passages. It set out what the duties of directors are in approving financial statements.
No, thanks for that, Professor. Tanya, I mean, I think it's appropriate that we come back to you at this point. I mean, when Professor Katz refers to as a regulator that essentially then had to sue the custodians of a company in relation to something that had gone wrong, that seems to be another tension point that we have in South Africa, in that, for example, if I am a current director at Steinhoff, I believe that my fiduciary duty is towards the company. So therefore, if it turns out that I've stumbled upon a report that says, oh, actually, these are the things that have gone wrong and this one needs to happen, and I release that report to the public, and then it comes back and it bites the company because its market value, for example, collapses or something else goes wrong, it seems like I'm caught in a corner where I have to somehow figure out, what is my duty to? Is my duty primarily towards the company, or is my duty towards society at large? Have we found the right balance between navigating what directors can and cannot do in relation to some of the fraud that we've seen being uncovered, or is it simply a matter of we're going to have to wait and see when we're going to get proper law enforcement agencies?
Khaya, I think it seemed to me that you were implying that a director would be okay to turn a blind eye once they find a problem. And I don't think under any societal norm would that be acceptable. So I agree that there is a tension that when a director finds something that has gone wrong, they now need to deal with it. I don't think you can turn around as a director and say, well, now that I've found something, let me ignore it. Yes, questions will be asked and the matter needs to be unraveled, that should a rational director have fulfilled their duties correctly, that they would have helped have the correct controls in place with this particular fraud in the example that one would be talking about. Could the fraud have been prevented? And to Michael's comment that it is the director's responsibility as a starting point to make sure that the controls of right people are employed. But as I say, any sort of suggestion that now that you found it, you turn a blind eye to avoid falling foul of the law yourself. I don't think that as I say, any rational society would accept that sort of environment.
Tanya, there seems to be this this conversation in the Steinhoff case, for example, in that what we now know is that Steinhoff did indeed commission a forensic report that told them exactly what the scale of the issues was there, what the scale of the fraud and the corruption was there. And then when it came to the law enforcement aspect, it looked like that same report could not be handed over to law enforcement. In fact, we then ended up with a truly extraordinary situation where Steinhoff itself said, well, we'd rather finance a separate investigation by the law enforcement agencies in order to essentially, I imagine, come up with the same conclusion. So the question that a lot of people raised was to say, well, what is this fear that the current directors of Steinhoff are sort of trying to mitigate by saying, we're not going to tell you what that completed report has said, go and start your own process, and if you can't afford it, here's the money for you to do it.
It's probably not appropriate for me to delve into the specifics of a Steinhoff, as it were, but I'm not sure that the directors would necessarily be acting out of fear. So this is a highly complex case, and I think that Michael, as the very well seasoned lawyer on the panel, would be far better to talk to these sorts of cases and the responsibilities of the directors. I don't think it's out of fear that they're not sharing the information. It's often because they themselves have to continue with their particular fiduciary duty to chase after individuals. And there's a lot of legal nuances. I don't think people would just turn around and say, well, we don't want to share it with you. And that a regulator like FISCA, who would be the parties that are asking for this, would accept that position unless there was a very strong legal basis upon which information sharing cannot take place. And perhaps Michael would like to comment on this aspect.
Michael, reflections on the Steinhoff question?
Okay, what I understand, Khaya, is that there is pending an application to court in terms of PIA, for that forensic report of PwC to be handed over to the people who are requesting it. So I think let's wait the outcome. I'm told that it's pretty imminent.
Okay, that's a very important, something that we're going to have to wait and see. Stephen, coming back to you here. I mean, the key question that we're all trying to deliberate on is that clearly there is this big gap between what society thinks happens and what really happens out there. And in order for us to start addressing the gap, we're going to have to start chipping away at some of those blocks that have that have maintained this distance between what the world thinks and what really happens out there. And at this point in time, we're going to have to start talking about some low-hanging fruit. What are the things that you, as an auditor, really believe can be initiated in the interim to then say, actually, a day after this is implemented, perhaps the number of people who say we don't know what's going on here is going to be a bit less, on the basis that they have maybe, if nothing more, a better understanding of the systems and the processes. Sometimes when we talk about the things that happen in financial reporting, even the words that we use are so intricate and so elusive, it leaves many people unaware of what it is that's going on. And then only when they start to interrogate and start to engage, and then they say, oh, actually, it's even more complicated than we thought. What are the things that we need to start doing in the interim just to actually start narrowing down this gap, even before we go for the big ticket items like the forensics, for example?
Yeah. So Khaya, obviously, there's a couple of things that will need to happen before we can say we are narrowing this expectation gap. I think there's one around education, and I think there I see a big role for our accounting bodies, our regulators, just around ensuring or not taking for granted that the public understands what is it that auditors do. I think there must be a focus around educating, this public and various stakeholders around the audit processes. That's number one. But I think the substantial or the substantive changes that need to happen going forward, Khaya, I think that we obviously have to go beyond this phase of expectation gap. We need to get to a point where we close the expectation gap, because clearly the stakeholders in all of the public interest entities do have expectations that must be met at some point. Now, the first one, Khaya, is I think that the audit has been predominantly, for many years, focused on the financial information. And there's clearly a lot that needs to be done around providing additional or expanded assurance on non-financial information that is being reported by companies, because I think the body of information that is being reported by companies is what is being used by the user to determine or make decisions about that particular company. So I think there's a lot of scope for expanded assurance to go beyond the financial statements and start to tackle areas such as culture, as an example. Start to look at areas like KPIs. Is a company meeting its performance targets by sticking to their strategy? Now, these are things that the auditors are not today, touching on. But I think that as we evolve, it's going to become very important that the non-financial aspects of the reports that are being put out by companies also get some assurance, because I think there's a lot of that expectation gap that is sitting on assurance of non-financial information that is being reported by companies. Yeah. So I would say, Khaya, that's for me, the future of an audit has got to be that which focuses on both financial information and non-financial information. And of course, technology is going to have to play a big part as well in enabling the auditors to be able to be adequately equipped to be able to obtain different sources of data to be able to express their opinions on the reports that companies put out there.
Yeah, Stephen, some might argue that the public sector is already operating within that paradigm, and that if you're auditing public sector entities, it definitely goes beyond just the financial information. Maybe it's because of the very clear public interest dimension there, in that at the end of the day, service delivery has to be executed, and a fixation with the numbers would probably be a limitation on that constitutional promise. So this is a system that already exists out there, and yet for whatever reason, it doesn't seem to have been universally adopted by what you definitely would regard as public interest entities, particularly the listed ones, particularly entities with a huge workforce. What has been the gap there? Why have we not made that gap, that jump?
Yeah, and Khaya, I think it speaks to the standards, right? So the standards have not gone that far, and I think the standards need to evolve. Particularly today, if you look at the prominence of ESG, that information is very important, and companies are going to need to report on ESG, and somebody's going to have to need to provide assurance on it. So I think the public sector here is a little bit ahead with their performance information. That the Auditor General performs work on performance information. I think that's going to be a critical feature for companies as well, where performance information has got to be at some level audited and some assurance provided on that, because I think it's critical for the integrated information that is being reported by companies to be credible to stakeholders out there.
Yeah, Marco, this idea of actually looking at beyond the financial information and sort of looking at all the other dimensions that make all the wheels of the business move forward, would this on its own essentially get us closer to perhaps trying to pick up, the type of deviations, the type of gravitations away from the core strategy that essentially then become the openings for what may eventually become a large-scale fraud? I imagine that if we're looking at the holistic business, we'd be able to pick up the type of things that you say, wait, hold on, this is not what we committed to doing. This is not what was approved before. Why is there this deviation? Would that escalate maybe that type of skepticism to say, actually, what is the risk of this thing now being the deviation, being embedded into the practices? And is this the type of thing that may, in one form or another, end up leading to a fraud, for example?
Khaya, I think when I take a look at it, I mean, for me, the financial component is an outcome of activities. It basically translates the business into numbers. I think there is a lot of merit in understanding the business holistically, understanding the non-financial information, because I think it gives you a better understanding of the business, and as a consequence gives you a better understanding of where the directors are moving the business and their thinking. So, again, when it goes against the norm or it seems a little odd, I think then that does give the auditors the opportunity to question the rationality of that particular thought, and at the end of the day, again, sometimes it may just be that the business is expanding and looking at different avenues and revenue streams. And then again, that may give comfort that that's appropriate, but it also may talk to some of the red flags that come out through other discussions. Does that actually mirror what we've been told?
Yeah, that's quite a key question. Mario, when we talk about public interest entities, this is us acknowledging that some entities are such pervasive players in the ecosystem, whether they employ a lot of people or whether they're good taxpayers, that we regard them as public interest entities to simply say that it is important for those entities to be governed properly, for those entities to be governed with the right framework and the right state of mind. Are these then the type of entities that you should perhaps consider saying, in relation to what we now know is an ongoing risk of the fact that maybe there isn't sufficient levels of skepticism within the current audit environment, maybe the current auditing standards are not getting us to where we need to get to? Is this then the conversation that then says perhaps in order to minimize or at least reduce to some extent this risk that you now know, perhaps we should make it a law or a rule or a guidance that in every audit team, or indeed even in the board of directors, there has to be this one person whose core skill, whose core expertise is this elevated level of skepticism, this professional suspicion that forensic specialists in particular seem to specialize in.
Khaya, yes, that can be done. But again, you need, I think, those technical skills for the reactive side. For the red flag side, it's general awareness. I like what Stephen said, that we need to go beyond just looking at the financials. And Steve Albrecht is a professor at Brigham Young University. He's written a book called Fraud Examination. It's in its 7th or 8th edition. That's been my Bible for the last 15 years. And he talks about the fraud exposure rectangle. And he's saying there are 4 things that auditors need to look at. Number 1 is the management and directors. What type of people are they? What are their ethics? What's their background? If we take Steinhoff, the Viceroy reports alleges that certain directors at Steinhoff were being investigated for forgery, tax evasion, fraud. That's not a red flag. Number 2, company's relationship with other parties. There were multiple related party transactions within Steinhoff. Number 3, the organization and its industry, comparing how is my client doing to the rest of the industry. If we're in an economic slump, how come my client's doing so much better than everybody else? Here you had Steinhoff buying underperforming furniture businesses for increased rates. And then lastly, the financial results and operating characteristics. And again, I say you don't need to be an expert. If you take one of the high-profile cases, which is Health South, American case, the revenue and assets were increasing while the number of Health South facilities were closing. Less facilities, but more profit. These things are all related. So just a matter of stepping back and looking at the bigger picture.
Yeah, that's definitely something that needs to be done with a greater level of interrogation, I suppose. Professor Katz, I mean, when we now try to figure out what needs to be done, I would imagine that the JSE in particular is indeed very persuasive out there in the market. The King Code of Corporate Governance seems to be the one guiding document that a lot of us in the corporate landscape are using in order to say, actually, this is what the best practices are. Do we have enough of an entry point using maybe the King report to say, well, let us have a separate section dedicated to saying to companies, this is how you must deal with the fraud dimensions. This is how you as the board of directors need to inherit particular responsibilities and particular duties in order for us to sort of reduce the risk that currently exists?
Sorry, so Khaya, I don't believe that the problems we're discussing today have anything to, sorry, let me not overstate it, manifest any defect in the regulatory system. The content of company law, directors' duties, auditors' duties, I think is more than adequate. So where are things going wrong? I think in 2 areas. Number 1 is culture. And I think that the world is moving towards a totally new dimension. There is new thinking on the purpose of a company. That a purpose of the company is to reconcile doing good and making profits. And the better thinking today is that there's no conflict, there's no tension between them. Once you understand that the purpose of a company is to do good, and that's the culture of the company, then I think you're going to have a reduction in fraud. Along those lines is some research. Professor Lynn Sharp-Payne at Harvard Business School, in a wonderful book called Value Shift, shows that there's a positive correlation between superior financial performance and higher ethics and values. So there's that. So if you see what the purpose of the company is, to do good in society, and related to that, superior financial performance has a positive correlation with high ethics and values, that's likely to reduce fraud. So culture is very important.
Yeah.
Then look at something on the other spectrum of this, and that is the regulation. As I say, I don't think the problem is in the content of the regulation. The South African Companies Act is amongst the best in the world. There is much there. Enforcement is a problem. And there was a very famous analysis done on insider trading in America and high white-collar crime. And what was said is, what prevents it? What is the biggest deterrent? Not stiff sentences. The first important deterrent is a fear that you'll be caught, you'll be apprehended. The second big deterrent is, having been apprehended, you'll be successfully prosecuted. And only the third one is the severity of the sentence. So we do need the deterrence of apprehension for significant frauds and successful prosecution. But with respect, my last point is that the whole regularization of the environment, of the enforcement, assume we've got a good culture, good ethics, and there's good enforcement in the NPA, but there's still a lot that can be done in the private sector. You can have removal of delinquent directors. We have very, very sophisticated provisions in our Companies Act for the removal of directors by shareholders. We have provision for delinquency declarations. So I think it's the totality of this that we can expect will be helpful in reducing these corporate fatalities.
Thank you. Tanya, one point that people keep raising is that perhaps the punitive regime is simply, is not enough of a squeeze. Some people have compared some of the fines that we've heard about in that it seems like, well, actually, most companies can afford this. But I suspect one question that always emerges from me is whether people who set out to commit fraud actually go and look at what the possible sanctions or fines might be before deciding to embark on an action. And I suspect that a lot of people who do these things aren't probably bothered about the question of what the fines might be, because again, the primary instinct is to assume that they're not going to get caught. And if they do get caught, they'll find a way to maneuver way around the system. So when people say that the fines should be more punitive, I tend to wonder, are the people that end up committing these frauds going to look at that and say, oh, no, definitely let me not do it because it may turn out that I'm going to pay those millions? I suspect they don't think they'll ever get caught in the first place.
Absolutely. So the critical part is that in order to deter people from going down a path that they shouldn't, is there should be a real possibility that A, they'll get caught, B, that they will be able to be successfully prosecuted. And then obviously then the third step is that the fine or the jail sentence or whatever it is sufficiently strong. There's no point even if you get caught, even if you fail in the process and then you're only fined 100,000, that's nothing credible at all about it. So the first starting point must be those fines, but absolutely, it's within that entire legal system that we need to be able to hold people accountable. And that will be a very important test from a South African perspective, is as these things go along, that the various regulators are able to successfully prosecute individuals. And there have been some good successes in relatively short time periods. I think we all want something to happen straight away, but any legal process takes time. But I do think the likes of FSCA has been able to be very successful in terms of holding some of the individuals within the Steinhoff saga to be accountable. It might not be the exact issue that you would have hoped that they would have gone after, but there is so many different pieces of the puzzle and so many things that can go wrong, that in terms of these sorts of cases. So if it's a matter of insider trading that they were able to prosecute quickly and effectively and large sums, then absolutely that is I think the right way to go, and that's a credible deterrent. That's not to say that the other parts might not fall in place, but as we know, in terms of a legal process and gathering evidence, it does take time.
Yeah, Tanya, I mean, the JSE is remarkably persuasive in relation to our entire financial ecosystem. And one of the points that's just emerged in the chat here is the question of whistleblowers. And of course, we now know that whistleblower hotlines at least enable people who may pick up things that are going wrong to be able to have that ability to then say, I think something is going wrong here. But I'm not sure if whistleblower protection mechanisms or even whistleblower hotlines are universally practiced across the ecosystem. Do you, in your perspective as a regulator, think that perhaps if we had a very clear guideline that every listed company, for example, needs to be able to indicate to us that there's a whistleblower hotline, which at least gives the space, some breathing room to people internally or externally who may be able to pick up these things to be able to say, at least I pressed the red alert? Is this the type of thing that at least then narrows the possibility of everybody turning around and say, we didn't know what was going wrong?
So within the South African environment, there absolutely are various whistleblower environments and protections, and individuals need to follow those particular routes. Khaya, I think you're referring sort of more closer to home as to should an individual entity, or how should an individual entity establish its own whistleblowing structures. All of this comes back to culture as well. You can set up these whistleblowing facilities, etc. But if the culture in the organization is wrong in the first place, it's going to be very difficult for individuals to come forward to the company itself. And there's a lot that needs to be built in terms of encouraging and then protecting whistleblowers.
Stephen, I mean, when we do talk about whistleblowers, the one risk that always exists is that even if a whistleblower mechanism is externally administered, when it comes to the type of fraud that we see, you as the boss who was doing it are probably going to figure out that I must be the one that reported you simply because I'm the only one that sort of had insight into what has happened. And I suppose also the other tension point is that for a lot of individuals, they might want to try and get clarity from the internal structures first to say, wait, what's going on here? And if they don't get that satisfaction, then escalate it to the whistleblower mechanisms. But if the risk exists that everybody's going to know that you are the one that was asking a question yesterday, you're the only one that could have done and blew the rest of the day after, the risk is not really addressed now, is it?
Yeah, no, correct, Khaya. I think I'd start by saying, all whistleblower mechanisms have got to be designed such that the whistleblower can be protected. And preserve the integrity of the whistleblowing process. I think if you lose that integrity, then it doesn't, serve the desired objectives. But I will say, though, that, from an auditor's point of view, I think that this is an area that, similar to, the talk about doing more around forensics or using forensic specialists in the audit. I mean, these are things that the auditors ought to be assessing to look at whether there is indeed fraud risk indicators that come out of whistleblower reporting. And it's not just whistleblowers, short seller reports as well. External information that could be indicative of the occurrence of a fraud in an organization has got to be assessed Firstly identified and then assessed to a point that the right procedures can be designed to respond to that. But I think ultimately that entire process has got to be designed such that it's of integrity and it can protect the whistleblowers.
Yeah. In addition to that, I mean, we saw in the Viceroy report, for example, and I suppose Viceroy is a good example because they had one good report and they had one very, very problematic report. When you as an auditor that's auditing either Capitec or Steinhoff itself then get insight into that type of a report prepared by a short seller, is this the type of thing that we see auditors taking into account and saying, wait, hold on, let us look into this, let us ask the type of questions that are being initiated by this report, or is it simply a matter of, as it turned out in the Capitec case, it may just be short sellers with an interest in directing a share price in a particular way. So therefore, anyone who followed up on that report in relation to Capitec would have actually ended up with a lot of wasted hours because it turned out that there wasn't much substance in that report. How do you as auditors navigate that?
Yeah, Khaya, I mean, it's one that requires judgment. I think that the first thing to do is not to ignore short seller reports. It's to actually go into what is being reported and see whether you could find any corroborating evidence that supports what the short seller reports are saying. But it's by nature, given that short sellers also have got their own objectives, you also have got to use a lot of judgment in analyzing that. And I think that's where the need to involve other specialists becomes important, that the audit team has got to involve other specialists in the firm, such as forensic specialists, to actually help them with an analysis of some indicators of fraud that may be coming out of a short seller report, and not purely take it as speculation without necessarily designing a response to it. I think at the very least, the auditor has got to perform procedures that would put them in a position to make a conclusion around a short seller report.
Thank you. Marco, in the United States, Sarbanes-Oxley became obviously the reaction to major scandals that had been seen then, and it probably changed a few ways in which reporting was done in relation to public entities, for example, and how, well, at least entities that are in the public arena. Is this a type of conversation that perhaps should be considered in the South African context, particularly around the internal controls? Because I suspect for a lot of people, the only thing we hear about a company's internal controls is one or two paragraphs in the annual report or even in the auditor's report that simply says we looked at it and everything is perfect. In fact, no one has ever said something is a problem. Should we look at it doing it a bit differently?
So Khaya, I suppose it's again goes back to my statement about restoring the public's confidence in entities in general and possibly the supporting structures like the auditors. I think there's two things. I think one, I think there is a need to have additional information that gives comfort and creates a real stage for transparency. But I also think there's a need not to create a level of panic when things are disclosed. So I think the journey for me is to say, how do you create that transparency, but also not create a level of panic or the interpretation of the various items are misconstrued by different users of the financial statement. So I do think it's a fine balance, but in short, I do think a level of greater reporting and greater transparency is needed. I think there needs to be greater accountability by the people signing it off, so the CEO and the CFO. And I do think they need to understand, and probably at an operational level, that the internal controls do function. So I get the bit that you can delegate, but I think, the delegation without that comment around supervision is really key. I think there needs to be a level of work done by the board independently, possibly to just get themselves comfortable with the fact that the internal controls work, and then the disclosure around it should then support some of the engagements and findings in that particular area. So yeah, that's the way I see it.
Mario, the one limitation of an audit has traditionally done is that it's still essentially a retrospective science. You show up after long after everything has been done. Are we seeing perhaps a shift in some companies to say, let us be more prospective in dealing with the forensics question? So in other words, let's get the forensics guys firstly to come in and assess our system so that they can sort of document for us what the possible red flags are. Because I imagine that if the auditors, the external auditors come after something has gone wrong, and even the forensics guys come after something has gone wrong, the lessons that get learned there are probably not going to be as strong as the lessons that could have been learned if you had sort of actively interrogated your systems earlier on and say, we understand that there's an inherent risk. Can you, as a forensic eye, tell us what the blind spots are and the red flags are so that we are at least prepared to react? Because I think what we're seeing in a lot of these cases, there is a sense of panic because suddenly people are like, we didn't even know that such a risk existed. Now the risk has materialized. We now don't know how to manage it. And it simply just escalates the crisis.
Yes, Khaya. We found that it's the minority of organizations that are proactive. They want pen tests or they want fraud risk assessments, but it's also how you do it. A fraud risk assessment is not a very sexy document. It's a document that basically says, this is where your controls are not working properly and you could have problems. And management, you know what, management say, well, I'm busy now, I'll get to it next financial year. So we advise organizations to do data analytics with the fraud risk assessment. We hold the data analytics report back because that shows you actual anomalies and duplicate payments, conflicts of interest. So we give the fraud risk assessment, we go through it, and then when management generally comes to say, oh, it's not that important, we say, but it is, here's the data analytics, look how much money you could be losing. You need to do something now. And generally they get it.
Yeah, and I'm hoping that it's becoming far more pervasive across the ecosystem because I think it is clearly something that could be beneficial into just protecting these companies and the various stakeholders out there. But I suppose it doesn't come cheap, Mario, and that's probably one of the pushbacks that you're going to get to say, well, it sounds like it's an optional thing, and because we don't think we are a fraud risk in the first place, maybe that's one of the reasons that management says we'll deal with it next year.
Yes, Khaya, it's not cheap. It's hours, but COVID's forced us to look at things a bit differently now. So the key for a fraud risk assessment is we used to do a survey, have management interviews, do a walkthrough, focus groups. So now with COVID, we going online. So it's a little bit more cost effective, and at least a survey can give you some indication. You know, the fraud risk assessment and data analytics works together. People say to us, where are my hotspots? We say, well, either do one first, which will point to the hotspots, then do the other one, or vice versa.
And I think those are the type of permutations that we definitely need to explore a bit more in order for us to sort of start getting towards a solution of some sort. Professor Katz, one of the practices that exist in South Africa in particular is that if I, as an auditor, do pick up that there's probably things that I'm really concerned about, and I think that perhaps are not being done the right way, is that I've got the ability to then escalate it and report it to the audit regulators, for example. However, my personal fear is that for most cases, when that tends to happen, there are other considerations at play. And the primary consideration is that you may lose the client, or the client may simply fire you on the basis that, well, maybe they don't agree with your assessment that something is going wrong. Maybe they don't agree that this is something worth escalating. Do we see perhaps enough protections even for the people that do pick up that things may be going wrong in order for them to be able to say, in spite of the audit fee that I expect to get, this is something that I need to escalate so that it doesn't get covered up? What's been your experience there?
Sorry, Khaya, I'm not sure that I understand the question. If you're talking about reportable irregularities in terms of section 45, with respect, I think that my own experience, where an auditor sends the first letter to the company telling them they've found the reportable irregularity and giving the company the opportunity to remedy it. My own experience is that with respect, it doesn't necessarily bring out antagonism with the management. Often the directors, the people who consult me, when something like this is raised, are only too happy if the concern arose at management level and now they're seeing something that's happened. So I think that this antagonism, the alleged antagonism that arises because an auditor does their duty, is, I think, not well-founded. Obviously, in certain cases, yes, but, and I think that there is the board, there's a hierarchy. There's the board, there's the audit committee, there's management. I think the problem one's seeing today, unfortunately, is that auditors have an overwhelming fear because of the corporate casualties that have occurred. Steinhoff, Tonga, African Bank, all the ones that have been mentioned here today. Auditors, I think, on occasion, and I have every respect for conscientious auditors, but on occasion are raising as reportable irregularities issues that aren't, and that by being raised could have a serious implication for the company. So I think this is judgment. Where it is a real concern, they must do their duty. And I've seldom seen boards of companies, reputable boards, being upset when the auditors do their duty. The concern arises a little bit where auditors, and one understands, are in a state of great fragility at the moment and perhaps are inclined to do over-reporting, which could have an implication to the company. That's perhaps more of a problem, but I think it's limited in its duration as the pendulum swings again. But to answer crisply, I don't see the tension that you mentioned. When an auditor does their duty, it's in the best interests of the company, not otherwise.
Yeah, Tanya, as a regulator, you've probably seen some indications of what really happens in that reporting process. It is something that was obviously introduced into the financial reporting ecosystem as one of the tools that was regarded as important in keeping the system in check and keeping the system honest. What's been your reflections around that particular instrument as one that may perhaps narrow down the possibilities of fraudulent conduct?
In terms of reportable irregularities?
Yes.
You know, so the reportable irregularity needs to be, first of all, dealt through from an URBA process. You're aware that there's that initial referral. Management is given time to respond to the issue to cure the reportable irregularity, failing which essentially the auditor will report to URBA 30 days later whether that RI is continuing. From an URBA responsibility perspective, they would then push that information to the appropriate regulator. So there is this flag, there is this RI, and they would then push it to whoever needs to take the appropriate action. So, for example, if it is a VAT fraud, they would then directly be pushing that information through to SARS. And in that sort of context, I think that one can see that it would be enormously beneficial for SARS to have this information right up front. They've got that reach straight into the company to understand that there has been an explicit breach, as it were, of their jurisdiction, of their legislation. When it comes to broader fraud type of issues, it's I don't have exact numbers and the likes thereof, but I think it's difficult to say with confidence that RIs have been effective in broader scale frauds. So as I say, smaller pieces of legislation, I've certainly witnessed those sorts of RIs coming through. In terms of the scale of the corporate scandals that we've seen, the fraud is often or the news of the fraud often breaks before the auditor is aware of it. And in fact, then one gets a frantic call from the auditor to say, hang on, guys, the company's told us they've uncovered something, their controls have identified there's this issue, so now they're trying to unpack it further, and now we have an RI responsibility. So it's often coming afterwards, and I guess that's perhaps the nature of it into tomorrow's conversations in terms of that responsibility for the fraud and that. And I guess that depends on the timing as well. So maybe a company has uncovered the particular fraud, the auditor is coming in a month or two later to do its audit, and the question is now about how they deal with it. And in that type of context, the reporting of the RI, one has to believe it's not really that signal that you would have hoped, but I guess it's the nature of the timing of who is there. And to the extent that the company has identified the fraud, that they've identified there's been a breakdown in controls, and they are then on top of it, I think that's our first prize. That means that they are then driving, getting the right things going. I mean, we spoke earlier, for example, about the Steinhoff case and your view that the directors are trying to protect themselves. I think what you forget is it's not the directors that were there at the time that the corporate failure happened that are now driving this forensic report. It's new directors. So that is often extremely helpful, as when there are new directors that come on, they've got nothing to lose and everything to gain by helping to uncover that fraud. And I think that makes everyone's job a lot easier. Very different and very challenging, I think, for an auditor. I would imagine if it's the same management who is perpetrating the fraud, for them really to get to the bottom of it, that they would then be able to report this as an RI.
Thanks, Tanya. Stephen, I mean, obviously, as an auditor, you probably have had some of these deliberations where you had to make a call on whether this was indeed something that is reportable. What tends to be the reaction of management when you do sort of then say, actually, I think this is a bit of a red flag. I think this is something that may have to be escalated in one way or another. Are we seeing that embrace that Professor Katz spoke about? Or is this the type of thing that it creates new tensions and suddenly it looks like, wait, you're threatening to report us to the regulator? On what basis?
Yeah, no, Khaya, I think by its very nature, it does create tension, but I would say healthy tension is something that we need to be comfortable with. But depending on the culture of the organization, you then find different responses to reportable irregularities. Indeed, some organizations embrace these reports because they see it as an opportunity to improve. However, again, linked to culture, you do find at times that some, have a very negative response towards the auditor, carrying on to report to the regulator. So I would say overall, it's very much linked to culture. But a lot of organizations, in my view, do embrace this. There are some that do, end up in a breakdown in the audit relationship, even withdrawal by the auditor. But in the main, I think that you do find that companies embrace the opportunity to improve based on reportable irregularities.
Yeah. Marco, the concept of culture has been very prominent in this conversation, in that it's very clear that at the easiest and perhaps the most important win is to get the right culture embedded in an organization so that nobody even considers doing the type of things that eventually escalate into the type of fraud that we're talking about now. And of course, I suppose fixing it at that stage, preventing the frauds from occurring, means that the question of the expectation gap is probably not going to be as manifest if there are no frauds to begin with, or to test the prism of that expectation gap. From your perspective as a financial statements preparer, what does it take to get the right culture? Is this the call for the board of directors, or is this the call of hoping that you get the right individuals to be employed then? And what do we need to do in order to make it perhaps a more universal practice that the culture of the organization must drive its practices and avoid that we see some of these malfeasances that we've seen in the past?
Khaya, thanks. And I think it's a very important question. So, I mean, like most things, I think it does start at the top. I think, this has to be led by the directors, the MDs, the CFO. So firstly, it starts there. Secondly, I think there needs to be two important aspects to it. One, there must be zero tolerance for fraud, okay, which then creates that base to say this is what the organization will not stand for. The other one has to be the ability to speak up. And that ability to speak up has to be done without fear and there has to be appropriate structures in place so that it can be done. And then the person who's raising the matter has to do so in a responsible manner. So again, I think there are rules of engagement around this that every party has to abide by, and I think those are really the crux of it. And I think it permutates further than that. I suppose it will go to your association with certain types of suppliers and stuff like that. You need to surround yourself by the same people with the same moral compass that you do. And sometimes, you've got to take a hard call and walk away or not, but it has to be ingrained in everything you do. It can't just be to say, okay, we've got a zero tolerance for fraud, but everything else, those gray areas we're happy to kind of live in because there's a profit component coming through or whatever the thing. It really needs to be part of your DNA.
Yeah, and when we speak about the DNA, it's obviously quite key that the company has an ability to continuously interrogate what it is that its employees in particular are doing, so that you can sort of start picking up the things that are maybe the red flags, as it were. I know maybe in the banking system, things are much easier. If the bank says you must bank with us, then they can immediately see that maybe your cash flow patterns are not mirroring what it is that you're being paid out there. How do companies then sort of put themselves in a position where they can continuously interrogate themselves to ensure that they stay on the right side of this culture divide, Marco?
Look, I mean, I suppose, again, it's about understanding who you do business with, why they do business. And I suppose at the end of the day, you will see from time to time certain behavioral trends. And again, the question is, are you comfortable to engage with them, and aren't you? So that professional skepticism, I don't think only applies to auditors. I think it should apply to any businessman or entrepreneur out there. So I mean, I think that's it. I think when one takes a look at the banking aspects and the ability to delve in because you're lending money, you will have your financial and, funny enough, your non-financial information, which will inform your decision and understanding of the business. And again, I think one of the key ones is understanding the way that management team does business and that management team's transparency. So it's aspects like that again, the principles seem to be quite universal, regardless whether you're the auditor or not. They need to be applied.
Mario, we've been focusing a bit on the question of the fraud that essentially it germinates internally, but I suppose there's also a very, very real reality that a lot of the third-party fraudulent conduct has hurt South Africans in particular. If you look at the State Capture Commission, it does indeed indicate that third-party and external service providers were intimately engaged in what amounted to fraudulent conduct. If it turns out that I, as the finance clerk, have received 3 quotations and they do look like they're 3 legitimate quotations, I may as well indeed process them, unaware that in the process of getting those 3 quotes to be delivered to me, there was then an element of collusion between the service providers and maybe even somebody else higher up the value chain. What do people who then work in such an environment, how do they then insulate themselves from the reality that external parties may indeed be the reason we end up with this fraudulent conduct? Do we see systems that are able to sort of interrogate some of the third-party service providers with that granular detail that enables them to pick up the red flags, or is it still just a gamble?
Khaya, we're seeing a bit of a change. You take, for example, tender committees. In the past, the tender committees didn't really have much training and awareness in terms of fraud and the red flags. And important to have maybe the internal auditor sitting on that committee or the forensic person. And